Hi there, it's Friday the 28th of February 2020. I'm Steve Towers. Welcome to ITB. Let's get started. The G20 finance ministers at their meeting in Riyadh last weekend endorsed the inclusive framework's key deadlines for Pillars 1 and 2. Their communiqué says this: "We encourage further progress on both pillars to overcome remaining differences and reaffirm our commitment to reach a consensus-based solution with a final report to be delivered by the end of 2020. We stress the importance of the G20 OECD Inclusive Framework on BEPS agreeing on the key policy features of a global and consensus-based solution by July 2020, which would form the basis of a political agreement." There are two interesting developments to note. The first is that during the International Tax Symposium, French Finance Minister Le Maire suggested that Pillars 1 and 2 could be implemented in a phased or step-by-step manner. And the second is that US Treasury Secretary Mnuchin told reporters that there's pretty much consensus now within the G20 that we should have the guilty. Meanwhile, the Czech Republic's finance minister has stated that the government will consider reducing the country's DST rate from 7% to 5%. The China-US Phase 1 trade agreement is being implemented by China on schedule, according to the US Trade Representative and the US Agriculture Secretary. For a copy of their press release, please go to our website or app. The OECD has released Stage 1 peer review reports on BEPS Action 14 for 8 jurisdictions. For a copy of the reports, please go to our website or app. And the OECD has released IT tools to support the implementation of the TRACE initiative for claiming withholding tax relief and also for exchange of tax information. For a copy of the OECD's press release on this matter, please go to our website or app. In Australia, the tax authorities have updated their guidance on the meaning of international related parties for transfer pricing reporting purposes. The update includes 4 examples. For a copy of the guidance, please go to our website or app. In Hong Kong, the government has presented its 2020 budget in the context of a poor economic performance and outlook due to the street protests, the China-US trade dispute, and now COVID-19. From a corporate perspective, there are several interesting items. Firstly, a tax concession will be introduced for carried interest in regard to private equity funds operating in Hong Kong. This is what the budget speech says on this topic. Please hit the pause button to study it. Secondly, the government has indicated that it will likely provide further tax incentives in the maritime sector. You'll remember that the government has already proposed tax concessions for ship leasing. A draft bill on this topic was released earlier this year. Well, in the budget speech, the government has indicated that it will probably do more in this area. The government will also explore other tax measures to attract more global shipping business operators and commercial principals to set up business in Hong Kong. And you might have seen headlines that there will be a 100% reduction in profits tax in the current year. Well, don't get the champagne out. There's a ceiling of 20,000 Hong Kong dollars, which is about 2,600 US dollars. In India, the Delhi Income Tax Appellate Tribunal has decided a case in regard to the attribution of profits to a PE under the Business Profits article of the Austria-India Treaty. An Austrian company entered into 2 contracts with an unrelated Indian company. The first contract was for the supply, in other words, sale of specialised machinery, and the second contract was for services in regard to the commissioning of the machinery. In regard to the supply contract, all of the activities were performed by the Austrian company outside India. However, in regard to the services contract, all of the activities were performed by the Austrian company's employees at the Indian company's business premises in India. The presence of the Austrian company's employees at the Indian company's business premises caused the Austrian company to have a PE in India under Article 5 of the Austria-India Treaty. The Austrian company conceded that there was indeed a PE under Article 5(2)(I), which says this: the term permanent establishment includes especially a building site or construction, installation or assembly project or supervisory activities in connection therewith, where such site, project or activities for the same or connected project, site or activities continue for a period of more than 6 months. However, it was argued by the tax authorities and disputed by the Austrian company that there was an Article 5(1) fixed place of business PE at the Indian company's business premises. The tribunal does not give a clear conclusion on this issue. The reason the Austrian company thought it to be important for it not to have an Article 5(1) PE was that it wanted to avoid any part of the profit from the supply contract being attributed to the PE. In other words, it wanted to limit the profit attributable to the Article 5(2)(I) PE to the fee paid under the services contract. But that objective failed. The tribunal held that the 2 contracts were together a composite contract. It also held that the services contract was the more valuable part of the composite contract from the perspective of the Indian company. In other words, a critical reason for the awarding of the 2 contracts was the assessment by the Indian company that the Austrian company was able to perform the activities under the services contract. The tribunal therefore held that a portion of the profit from the supply contract should be attributed to the PE. And based on previous Indian case law, in particular the 2011 Rolls-Royce case, the tribunal decided that that portion should be 35%. For a copy of this case, please go to our website or app. In Malaysia, the government has announced an economic stimulus package to address the economic impact of COVID-19. The package proposes several tax changes impacting companies, notably monthly income tax instalment payments for businesses in the tourism sector will be deferred from April to September 2020. Hotel operators will be exempt from the 6% service tax from March to August 2020. And accelerated tax depreciation will be available for expenditure incurred on machinery and equipment, including information and communications technology. In New Zealand, the tax authorities have released for public comment an officials issues paper on a range of GST topics, which are listed here. Please hit the pause button to study this list. Public comments are requested by the 9th of April. For a copy of the paper, please go to our website or app. In the Philippines, the Satira tax reform bill has finally made some progress in the Senate. You'll remember that Satira will reduce the corporate income tax rate, which is currently 30%, by 2 percentage points for every 2 years until the rate becomes 20% in 2029. It will also impose significant limitations on corporate tax incentives. The House of Representatives passed the bill in September last year. Well, now the Senate version of the bill, which is similar to the House version, has made it out of the Senate Ways and Means Committee and has been introduced on the floor of the Senate. The Finance Secretary hopes that the bill will be passed next month. For a copy of 2 recent press releases from the Department of Finance, please go to our website or app. In Sri Lanka, the tax authorities have issued guidance on amendments which are proposed to be made to the income tax law and which are planned to be effective from the 1st of January 2020. The most notable proposed amendment concerns the standard rate of corporate income tax. It will be reduced from 28% to 24%. For a copy of the guidance, please go to our website or app. In Belgium, the tax authorities have issued guidance on the country's transfer pricing rules. As you would expect, the guidance is generally aligned with the OECD's 2017 guidelines. For a copy of the guidance, please go to our website or app. The European Court of Justice has decided a case in regard to the EU's freedom to provide services under Article 56 of the Treaty on the Functioning of the European Union. A Maltese company carried on a gambling business. An Italian company operated a so-called data transmission centre in Italy, which enabled gamblers to place bets electronically with the Maltese company. The Italian authorities issued a tax notice to the Italian company and the Maltese company on a joint and several liability basis for a single imposition of Italian betting tax. The court held that the tax notice did not breach the freedom of services in Article 56. The single tax applies to all operators who manage bets collected on Italian territory, without making a distinction on the basis of the place of establishment of those operators, such that the imposition of that tax on Stanleybet Malta cannot be regarded as discriminatory. The court also made this interesting comment on the issue of double taxation. Furthermore, as regards Stanleybet Malta's allegation that it is subject to a double taxation in Malta and in Italy, it must be recalled that in the current stage in the development of EU law, the member states enjoy a certain autonomy in the area of taxation, provided they comply with EU law, and are not obliged, therefore, to adapt their own tax systems to the different systems of tax of the other member states in order to eliminate the double taxation resulting from the parallel exercise by those states of their competences in respect of taxation. For a copy of this case, please go to our website or app. And the European Court of Justice has decided a case in regard to the EU's freedom of establishment under Article 49 of the Treaty on the Functioning of the European Union. The taxpayer company was incorporated and tax resident in the Netherlands. In 2007, the company incurred a loss from its operations in the Netherlands. In 2008, the company set up a branch in the Czech Republic. And in 2009, the company transferred its place of effective management from the Netherlands to the branch's address in the Czech Republic. That transfer caused the company to become tax resident in the Czech Republic and to cease to be tax resident in the Netherlands. However, the company remained incorporated under Netherlands law. In 2012, the taxpayer company sought to deduct for Czech Republic income tax purposes the 2007 tax loss which was incurred in the Netherlands. The Czech Republic law does not allow the taxpayer company to do so. The taxpayer company therefore claimed that that was a breach of the EU's freedom of establishment. However, the ECJ disagreed. It held that the situation of the taxpayer company was not comparable with the situation of a company which has always had its place of effective management and therefore its tax residency in the Czech Republic and seeks to deduct a prior year tax loss. For a copy of this case, please go to our website or app. In Germany, the Ministry of Finance has issued guidance on the application of the so-called royalty barrier rule, which is effective from the 1st of January 2018. Under the royalty barrier rule, a German taxpayer is partially denied a deduction for outbound royalty payments to a related non-resident, where the royalty income is subject to a preferential tax regime which is considered to be harmful by the German tax authorities. The guidance provides two non-exhaustive lists of preferential tax regimes. The first is a list of preferential tax regimes which are considered to be harmful, and the second is a list of preferential tax regimes which might be harmful, but they are still under examination by the German tax authorities. Notably, this second list includes the US FDII regime. For a copy of this guidance, please go to our website or app. Also in Germany, the Federal Tax Court has decided 7 cases in regard to the real estate transfer tax, RET, and in particular to the application of the intragroup restructuring exemption provision. For a copy of these 7 cases, please go to our website or app. In the Netherlands, the tax authorities have changed their view on the VAT treatment of management and administration services which are provided to CLO issuing vehicles. Their previous view was that such services are VAT exempt. Their new view is that the services are subject to standard rate VAT, which is 21%. That 21% is an absolute cost to the structure. Commentators have suggested that because of this change, there will be no more Dutch CLO issuing vehicles, and that new European structures will be established in either Luxembourg or Ireland. In Russia, a bill has been introduced into Parliament which will reduce the standard VAT rate from 20% to 15%. The bill will also reduce the current 16.67% VAT rate to 13.04%. These 2 reductions are proposed to be effective the 1st of July 2020. In the UK, the tax authorities have issued guidance in regard to the recent upper tribunal decision in the News Corp case concerning the VAT zero rating of digital newspapers. The guidance states that the tax authorities do not agree with the decision. they've been granted permission to appeal the decision to the Court of Appeal, and until the News Corp litigation is concluded, the tax authorities will reject similar claims. For a copy of the guidance, please go to our website or app. In Ukraine, the government has proposed that the standard rate of VAT be reduced from 20% to 17%, effective the 1st of January 2021. In Nigeria, the Tax Appeal Tribunal has decided a transfer pricing case on the basis of an interesting application of the transactional net margin method. The taxpayer company imported plastics and petrochemicals from a related company and sold the goods to unrelated customers. In its transfer pricing documentation, the taxpayer company used the cup method for 1 year. However, due to the lack of comparables to apply cup, the taxpayer company then switched to the TNMM method, using net profit to operating revenue as the profit level indicator. The tax authorities agreed that TNMM should be used, but they claimed that the appropriate PLI in the circumstances was gross profit to operating revenue. The tribunal summarised the tax authorities' argument in this way. The tax authorities took account of the various factors enumerated by the OECD transfer pricing guidelines in deciding that the gross profit margin was the most appropriate PLI to apply in the instant case. The tax authorities posit further that the use of the net profit margin would actually produce the opposite effect, while the gross profit margin stops at the level of direct income and direct costs. That it is the net profit margin that produces distortion by including other operating income and costs which are not included in the computation of the gross profit margin. That in the instant case, the tax authorities limited their analysis to direct sales revenue and direct cost of items produced by the taxpayer company in order to avoid distorting the comparability analysis. And the tribunal agreed with the tax authorities. For a copy of this case, please go to our website or app. In South Africa, the government has presented the country's 2020 budget. Several items caught my eye, all relating to corporate income tax. Firstly, the existing restrictions on interest deductions will be replaced by adopting a fixed ratio test based on BEPS Action 4, with the limit set at 30% of EBITDA. This change will apply to years of assessment commencing on or after the 1st of January 2021. The government has released for public comment a discussion paper on the design of this new limitation. Public comments are requested by the 17th of April. For a copy of the paper, please go to our website or app. Secondly, the government proposes the introduction of sunset dates for tax incentives. Here is the description of this policy change in the National Treasury's budget review document. I won't read it out. Please hit the pause button to study it. Thirdly, the government will impose a cap of 80% on the use of carried forward tax losses. This policy change is described in this way. Again, please hit the pause button to study it. And finally, the government has stated its intention to reduce the corporate income tax rate in the medium term from the current 28%. However, no specific change was announced in this budget. Also in South Africa, the tax authorities have issued guidance on the definition of group of companies in the income tax legislation. That definition is relevant for rules which provide income tax relief when assets are transferred between companies forming part of the same group. For a copy of the guidance, please go to our website or app. And finally, in South Africa, the tax authorities have released for public comment draft guidance in regard to so-called unbundling transactions, which are a form of corporate spin-off. Public comments are requested by the 31st of March. For a copy of the draft guidance, please go to our website or app. In Saudi Arabia, the tax authorities have issued guidelines in regard to rewards to be paid to whistleblowers who report breaches of the tax and zakat laws. For a copy of the guidelines, please go to our website or app. In Canada, the federal carbon tax has been held to be unconstitutional by the Alberta Court of Appeal. Specifically, Parts 1 and 2 of the Greenhouse Gas Pollution Pricing Act have been found to exceed the federal parliament's power and to encroach on the power of the provinces. In contrast, 2019 decisions by the Saskatchewan Court of Appeal and the Court of Appeal for Ontario found the Act to be constitutional. For a copy of the Alberta Court of Appeal decision, please go to our website or app. In Chile, the Amended Tax Reform Bill, which was passed by Congress in January, has now been signed into law by the President. In the US, the Congressional Research Service has released an updated version of its report on international corporate tax issues in the 2017 US tax reform legislation. For a copy of the updated report, please go to our website or app. And now for this week's treaty developments. And it's been another slow week. All we've had is 2 treaties enter into force. I have 3 articles for you this week. The first article is called Tax Abuse in Europe, the CJEU's N Luxembourg 1 and T Denmark judgments. It's written by Frans van Nistendal and it's published in Tax Notes Today International. This article concerns the so-called Danish joint cases, which were decided by the European Court of Justice in early 2019. The author describes the court's decisions in those cases as having the effect of a magnitude 7.5 earthquake on the European tax landscape. He continues, the first result of an earthquake is mass confusion, and that is exactly what is happening in the many publications now overflowing the EU taxation area. I present the cases as the perfect illustration of the fact that in the EU there is not a single and harmonized concept of abuse of tax law in the many situations in which the concept is being applied to determine whether tax is legally due. Furthermore, answers to the questions the judgments raise are of crucial importance to investors outside the EU because the cases involved non-EU private equity funds. And the second article is called Denmark High Court Ruling in the Adecco Transfer Pricing Matter with respect to Trademark License Agreement. You'll remember that I discussed the Adecco case in ITB on the 1st of November 2019. The author is Nikolai Bjornholm, and the article is published in IBFD's International Transfer Pricing Journal. The author indicates that although the dispute originated as a transfer pricing matter concerning the application of the arm's length principle to outbound royalties, the case was dealt with by the High Court on the basis that the royalty was not deductible as an operating expense, rather than by assessing that the royalty was not at arm's length. The author writes this: "The Adecco case shows that what commences as a transfer pricing audit may turn into a discussion of whether the expenses are deductible as operating expenses. Under Danish tax law, expenses are deductible if deemed necessary to acquire and earn the income. However, as with transfer pricing, a benefit test may be relevant, and as this was a key part of the assessment by the High Court, the author does not believe that a deduction versus an arm's length discussion had any bearing on the outcome. The Danish tax law provision on expenses is more than a century old and has significant precedents. In comparison, the arm's length principle is novel and based on the OECD transfer pricing guidelines, and precedence in Danish courts is still scarce. Danish judges would feel more confident assessing whether an expense is deductible as an operating expense than assessing whether the expense is at arm's length." And the third article is called Impact of Pillar 1 on Centralised Consumer-Facing Goods Business Models, an initial assessment through an illustration. It's written by Vikram Chand and it's published in the Kluwer International Tax blog. The author addresses this typical business model in regard to a consumer-facing business which sells goods. As you can see, there are 3 distribution channels: remote sales in state S1 by PICO, the principal, a limited risk distributor in state S2, and a full-fledged distributor in state S3. The author identifies the likely impact of Pillar 1 on this model. Well, that's the way it is this Friday, the 28th of February 2020. I'm Steve Towers. Have a great weekend.